The next subject I've been asked to cover is a publication that the Central Bank issued, the final one, in April of last year, which was basically a guide to, or guidance on secured lending valuations. I mean, the first thing we need to recognise is, following the collapse of the property sector, some difficult questions needed to be asked. Where were the points of responsibility? Clearly there was a lack of oversight, there was a lack of regulation, and where do you start to point the finger? In the wake of that collapse, the Central Bank of Ireland made a commitment to provide to credit institutions, i.e. banks and mortgage lenders, a document, a guidance document. And much of this really is about their issues as opposed to ours. It doesn't tell us as practitioners how we ought to be valuing properties, or whether the answer we get is right or wrong. It's procedural. And it's this document basically that I just want to go through and principally point out some of the key findings of it and a list of recommendations, and there are about 6 of them. Now, the first thing is the application. I mean, the paper states that this paper applies to all credit institutions regulated by the Central Bank of Ireland. So that's basically any major lender operating in the jurisdiction of Ireland. I think this is important, is that this paper is guidance. The Central Bank considers that the guidelines and recommendations contained represent appropriate process and procedures for credit institutions in considering property secured valuations. As such, the Central Bank would consider material deviations from that guidance as contrary to good practice. The Central Bank will, in matter of course, scrutinise the application of these guidelines as a part of its ongoing supervision. Now, if I'm honest with you, I think you talk to most regional managers and any of the major banks in Ireland today, and I'm not sure they'd know much about this document. And that's again a question for the Central Bank and for the major lenders. As I said, the Central Bank is not seeking to review valuation methodologies. It's not telling us as valuers the method of valuation we should be adopting, or ultimately if we're getting the right or wrong answer. That's something we need to recognise and look at ourselves. Credit institutions are clearly required to ensure that valuation standards comply with the best practice of international valuation standards. The Central Bank, in preparing this paper, observed that many best practice valuation standards have been completely overlooked, omitted, and in some instances totally disregarded. And I think I have first-hand experience of that. In the Celtic Tiger years, where there was huge volumes of work, the procedures and standards just fell by the wayside. Now, the Central Bank identified 3 major areas of weaknesses, namely inaccurate or inappropriate definition of valuation requirements, inadequate valuation processes and standards, or disregard to such processes, and a lack of appreciation of the significance of the valuation document as independent of risk mitigation effectiveness. And that's again something for the banks. That's for them to assess individual clients. What does that signify? What are we getting from the valuer, and what does it mean in terms of extending credit? Within the report, they suggest that the basis, one of which we're all familiar with, of market value, is an internationally recognised definition. And I'm not going to go through that, they're all familiar with it, but they're basically reinforcing that the basis of market value, as we understand it as valuers, is still the right one for secured lending valuations. Now, again, in terms of methodology and provision, there has been huge discussion concerning the basis of valuation in a market with little or no demand. And this is certainly a challenge for us as valuers in writing these reports. But that's a challenge we have to take face on. But they're suggesting that revised independent market valuations from a valuer with suitable experience, qualifications, and professional indemnity insurance is the most appropriate way to update the value of commercial properties held as credit institutions. Now, there's 2 issues to that. One is the bank's view on that, and who is the appropriate person to ask to do evaluation, but also us as valuers. I'm experienced, but there are certain areas of valuation I would not get into. And I think we're best to decline that and say, no, it's beyond my area of expertise, give it to somebody else. So that's a question I think all of us as valuers need to ask ourselves. Next one is this issue of frequency of valuations, i.e. how often should review valuations be undertaken? Is it every 6 months? Is it every 12 months? Is it every 18 months? In truth, there isn't an answer. But ultimately, the bank is suggesting, going forward, the banks need to be taking a conservative approach. And ultimately, should be applied to the expected timing and the amount of the proceeds included in the provision of an assessment. Critically as well is that they have to consider the risk exposure of that loan in terms of loan to value, the borrower's capacity to pay it, there are other borrowings, the property type, and so forth. So that again is an issue for the bank as opposed to us as valuers. Now, responsibility for valuations, they suggest valuation methodologies depend on assumptions and judgments, and that again as experienced valuers is something we have to deal with every day. They have to be decided by senior management under usual governance requirements, and the central bank has no role in recommending or setting specific assumptions or inputs for valuation methodologies. Again, as experienced practitioners, we recognise that the bank are not going to be telling us how to do valuations. Now, these are the critical areas that they found in terms of the principal weaknesses, and I suppose ultimately lessons to be learned. One was the weakness in instructions given to the valuer. In many cases, there weren't written valuations or written instructions. It was simply a matter of a phone call on a fairly ad hoc, informal basis. It's almost unforgivable now. We look back and say, bear in mind the scrutiny that they're going to do now, how did they do it? But we all recognise it happened. In terms of recommended now best practice, credit institutions should standardise all valuation processes. Letters instructions should be incorporated into the valuation report, as they are, to ensure that the basis and assumptions are also required. Valuers should confirm their instructions back to the credit institutions in writing. I mean, this is a key requirement of Red Book valuations, which apply to all secured lending valuations, and should be done as a matter of course. Conflicts of interest are unacceptable. Again, it really goes without saying, but they're highlighting this as one of the key failings of the procurement of valuations from professional valuers. During the volume-led transaction phase of the property development boom, certain valuation practices were accepted by credit institutions that involved significant conflict of interest. The areas they're suggesting here, the valuer's duty occurs to the credit institution, and this should be emphasised by credit institutions in the written instructions to valuers. Credit institutions should not use valuers or their firms where the valuer acquired the property on behalf of the borrower, or where the valuer is involved in the sale or letting of a property on behalf of a customer against the credit institution. Again, I have first-hand experience of selling properties to banks, and they would come back to you if the loan to value is modest and say, we'd like you to provide that secured lending valuation. It's a nonsense. It can't be done. It should never have happened, but regrettably it did. Instructions for valuers for property valuations on collateral security should come from the credit institution in accordance with its clearly defined terms of engagement. And finally, valuation reports should always be addressed to the credit institution that advanced the loan and not to the borrower. For the bank, they need to manage their valuation panel, and this again is a critical issue. They're suggesting there were weaknesses in the appointment and utilisation of performance review valuers panel by credit institutions. There were incidences, and I think we can all recognise them, in which valuation appointments were not assigned to a valuer with the requisite skills, experience and market knowledge, as a result of which inappropriate valuations were utilised. Now, that's again an issue for all of us, not just banks, but us as valuers. If a bank comes to you, there's a fee there, but do you want it? Can you provide that service? Do you have the requisite experience within that specific area? If you haven't and you're doubtful, you shouldn't be accepting it. Now, credit institutions, in terms of the best practice here, are suggesting should have a properly approved panel of valuers. They should review the valuer's PI insurance, and this is obviously an issue for all of us now. The panel of valuers should contain expertise in areas of property sector appropriate to the lending business of the institution and the location of lending. We all know property is very specific in terms of location and can differ. I wouldn't claim to be a practitioner outside of possibly comment. Again, if somebody comes to me, I'll refer it to a colleague, and we should always do the same. The experience of the valuer should be commensurate with value of the loan risk to the credit institution. Credit institutions should ensure that no one firm of valuers has the bulk of their valuations, i.e. more than a third. But finally, credit institutions should report any concerns in relation to non-ethical behaviour. That's really goes without saying. Fourth area they identified was the frequency of valuation review and the under-assessment of provisions. It suggests credit institutions often fail to conduct regular evaluations, thereby avoiding the issue of recognising valuation diminution, resulting in under-assessment of impairment provisions. If we think about the property market over a period of 5 to 6 years, commercial values have conservatively fallen by 60 to 70%, in development land probably upwards of 90%, and residential 50 to 60%, and possibly in some instances more. So we're talking about loss of value of maybe 12, 13, 14% a year. There's a huge drops in values, and the banks didn't take any provision for that. They effectively had book valuations that were outdated at a time where valuers were falling through the floor. The recommended best practice here is that the frequency evaluation should be based on the risk profile of the exposure. Policy and guidelines governing valuation frequency should be reviewed annually. Where there has been a material change, positive or negative, to the property by way of zoning, planning, permission densities, compulsory purchase order, transport links and so forth, revised valuation of property should be sought. And finally, for volume valuations like residential mortgages, an index such as the CSO is an appropriate method for reviewing a review provided the index itself is assessed regularly. If a significant house mortgage is in difficulty, then a specific valuation should be obtained. Sixth finding there is inappropriate use of informal valuations, and this is something that again happened, and we all recognise it was widespread throughout the industry. During the property boom, there was an increased reliance on informal valuations and updates by credit institutions. They were all utilised, or frequently utilised, as if they were full valuations, which clearly they weren't. And the recommended best practice here suggests credit institutions should have appropriate processes in place to flag outdated valuations and to trigger full valuation reports. Processes should ensure an appropriate audit trail and clear description of the valuation on file. Standardised templates for desktop or drive-by valuation should utilise to ensure clear identification of the type of valuation and to ensure consistency across all files. They go on to say such valuation updates should have a clear warning that they have limited value. It must be clearly documented that these updates are only tactical. It should not be relied upon for proper risk assessment purposes. And finally, loan templates should provide a summary of the last two valuations, and specifically when the last full independent valuation was done, with less prominence to informal valuation updates. They go on to say valuation inputs to credit decisions and risk management. Credit decisions did not sufficiently consider sensitivity analysis in the assessment of property values and credit management. I think particularly there they're getting towards developed land, which clearly made up a huge part of their loan books, where if, for example, rents fell by 5 or 10%, yields moved up, the construction costs went up, it may ultimately feed into a residual appraisal that made the loan to value, or whatever the credit they were assessing, unviable. So that idea of using sensitivity analysis was critical. Recommended best practice here is that there should be a greater use of sensitivity analysis in the valuation process, particularly with regard to costs, yields, and values financed, rental income, and the length of the construction period. Feasibility studies and business plans should be prepared for larger schemes, especially for mixed schemes. And finally, sensitivity analysis. Credit institutions consider the impact of property values in their scenarios, stress testing. And I guess this is, again, it's internal for the banks. I think the last key finding was training was inadequate. And here this is again, it's very much for the, it's an internal situation for the bank. Frequently, and we all know this, taking instructions from bankers, they didn't really understand the valuation process. I'm not sure they fully understand what we do, or indeed I'm not sure they do today. But from an internal point of view, there was inadequate training regarding collateral valuation methodologies, interaction with valuers, the interpretation of valuation reports, and the importance of valuations in credit risk assessment. The best practice points they raise there is when evaluation policy and process are reviewed, it is important that the knowledge gaps are identified and closed out through training. It is recommended that the relationship managers, these are the guys that would be dealing with borrowers on a day-to-day basis, and credit risk staff are specifically trained in property valuation methods and processes. And then finally, credit institutions should consider the establishment of in-house expertise to provide valuation property methodologies. Now that is again something I don't think the banks have. IBRC and some of these other guys with distress situations have brought in asset managers, but not necessarily experts just to deal with evaluations for secure lending. I'd summarise by saying that the more cynical would say, well, what's the issue because there's no secure lending valuations going on, but that's going to change. The UK had a similar issue in the 1990s when their property market collapsed, and that brought about the introduction of the Carlsberg Report, which reformed the Red Book. We're in a similar situation here. Clearly there's been huge failings of policy, of oversight, of governance, and I think all of us have to take a little bit of responsibility, but as practitioners going forward, those of you may be familiar with that document, those of you that are not, it's freely available online, and I'd urge any one of you that's involved in secure lending work to take a look at it. Thank you.